Welcome to Arena Finance, the voice of personal finance. I'm Rudy Banerjee and I'm here with my colleague IP. Welcome to session number 2 of our series where we will try to simplify loan concepts and explain it to you. Loans are an important aspect of our lives, be it mortgages, credit cards, etc. We will also discuss how credit score impacts the likelihood we get a loan and the amounts that we get approved for.
In this session, we'll provide an introduction to loans and discuss number 1, how a loan works, number 2, fees involved in loans, number 3, do's and don'ts of a loan. In part 2 of the loan series, we'll discuss loan amortizations and other aspects of a loan.
When we need to make a convenience purchase like groceries or clothes, or make a sizable purchase like a house, we may not have all the money in our bank to make the purchase. We may only have a portion of it. The rest we need to borrow. The amount of money we need to borrow is called a loan. When one of you borrows a sum of money, be it credit card, personal loan, or mortgage, this amount is expected to be paid back to the lender with interest. Terms of a loan can range from a few months to up to 30 years, as in a mortgage. Failure to repay a loan is called a default that leads to a much lower credit score and the risk of not getting future loans. Thus, it is important to make payments on time and pay off the loan completely over time.
There are two main types of loans. Number 1, secure loans. Number 2, unsecured loans. A secure loan is a type of loan that is backed by assets you own. The asset you own is called the collateral. When you take out a secure loan, you are putting your collateral as a backup in case you cannot pay your loan. If you can repay the loan, the lender can take the collateral to recoup their loss. Example of a secure loan are: number 1, mortgage. It's a loan that is taken out to buy a house. Number 2, auto loans. Loan that allows you to borrow money from a lender to purchase a car. Number 3, recreational vehicles loans, similar to auto loans. Now, let's talk about unsecured loans. When you take an unsecured loan, you don't need to provide a collateral. You will still be charged interest and sometimes fees. Example of unsecured loans are: number 1, credit cards. Number 2, student loans. A credit card is a payment or a plastic card typically issued by a bank, allowing its users to purchase goods or services or withdraw cash on credit. The amount charged on the card is a loan that has to be repaid later. Examples of credit cards are Visa, MasterCard, and American Express. A regular credit card is different from a charge card, which requires the balance to be repaid in full each month or at the end of each statement cycle. In contrast, a credit card allows the consumer to build a continuing balance of debt, subject to interest being charged. Student loan. A student loan is money you can borrow from the US Department of Education or a private organization to pay for college and repay later with interest. They are designed to help students pay for post-secondary education and the associated fees, such as tuition, books and supplies, and living expenses.
Now that you know what a loan is and the types of loans available to you, you may start asking yourself, are there any other costs available with a loan, or do I need to pay back just the principal and interest? Unfortunately, most likely there may be some other fees that you may need to pay when you get a loan. There are several fees involved when you get approved for a loan, which can be broken down into upfront fees and ones during the loan life. In terms of upfront fees, the most important ones are the following. Number 1, origination fee. When you apply for a mortgage, the lender charges an upfront fee of 0.5% to 1% to process a new loan application, which is also called an origination fee. Number 2, credit reporting fee. Lenders want to review your credit reports to determine your eligibility for a mortgage loan and establish the interest rate you'll pay on the loan. This fee is typically around $35. Other upfront fees that you may encounter are: number 1, rate lock fee, which is the fee charged by your lender to lock down your interest rate. Typically, you can expect to pay anywhere between 0.25% to 0.5% of your loan to lock in your rate. Number 2, title insurance, and number 3, transfer fee, both of which apply to mortgage loans. During the loan life, there are two different fees that one may encounter. Number 1, late fee. Payment of loans need to be paid on the due date. If not paid on time, the lender may charge a late fee. Late fee typically ranges from $25 to $40. Number two, early payoff penalty. Lenders like to collect as much interest as possible and would like you to take as much time as possible to pay off the loan. A mortgage prepayment penalty is a fee that some lenders charge when you pay off all or part of your mortgage loan off early. Understanding the types of loans and what costs are associated with them is the first step to your financial freedom. Now, we would like to direct your attention towards the two main types of loans that most people deal with and discuss them in more detail. The first category that we would like to talk to you is mortgage loans.
Typically, we have two main mortgage loan options. Number one, conventional mortgage, and number two, FHA loans. A conventional mortgage is your typical mortgage that you would get at a bank, credit union, or mortgage company. FHA loans are government-backed loans for those who might have credit issues. To get a traditional mortgage and have great terms, one needs to have a good credit score and be financially responsible. In an unpredictable interest rate environment, it's best to get a fixed rate mortgage versus an adjustable rate one. Try to pay 20% of the property cost as a down payment. If you pay a lower percentage as a down payment, you must pay private mortgage insurance PMI, which is an additional payment to your monthly payment. The PMI could be between 0.5 and 1.5% of your loan. So for a $300,000 loan with a 1% PMI rate, you may pay $250 per month only in PMI. Once you pay 20% of your principal, you can call your lender and ask to eliminate the PMI from your monthly payment.
Now that you know what your mortgage options are, let's do a simple exercise and see how much house you can get when we take into consideration your credit score. Let's say you have a gross income of $120,000 and you want your mortgage and property taxes not to exceed 30% of your gross income. That means you want to spend a maximum of $40,000 on housing. Let's say the property taxes in your area are $4,000 per year. That means you want your monthly mortgage loan to be $3,000 per month. If you have an excellent credit score, then you qualify for the lowest interest rate on the market. That is 7%. In that case, with 20% down payment, you can afford a $541,000 house. Meanwhile, if your credit score is lower, you will qualify for a higher interest rate, let's say 8.5%. In this case, keeping all other factors similar, you can buy a $468,000 house. That is a $73,000 difference in how much house you can afford. Now that you have seen how much house you can afford and you bought one, many people are wondering, should I pay off my mortgage as soon as possible or should I take my time? In this situation, there is no perfect answer. There are pros and cons on both sides, but here's what we think you should do.
Yes, you should pay off your mortgage if number one, you have enough emergency savings and extra cash. Number two, you are not savvy enough making other investment decisions. Number three, you have a high interest rate. And number four, you come from an old-fashioned family and paying off the house is seen as a big achievement. No, you shouldn't pay off your mortgage if number one, you don't have enough money for emergencies. Number two, you can make smart investment decisions, investments that will generate a higher return rate compared with your mortgage interest rate. And number three, you analyze the tax deductions on interest payments and it makes sense to keep the monthly payments to offset high incomes.
So now that you have a good understanding about loans in general and mortgages in particular, we want to direct your attention to a different type of unsecured loan. For example, credit cards. Most of you have credit cards. What many people do not realize is that the interest rates charged on some of these cards are over 20%. Some cards may have 0% or a low introductory rate to get you in, but it will move to a higher rate once the promotion period ends. Over time, this interest really increases the amount of money that you would need to pay the credit card company. Here is a simple example. If you have a $10,000 balance on your credit card with an interest rate of 20% and you make the minimum payment, you pay approximately $2,000 in interest for the year. Think what you can do with that extra $2,000. While in most instances we cannot do without a credit card, it is important to be disciplined. Making timely monthly payments is crucial. Also, if you get additional income, a bonus, a prize, or an inheritance, try to pay off your balance completely. On the positive side, credit cards, if used properly, number one, can help you maintain and or develop a credit history. Number two, get cash back. And number three, get points, which offer significant savings in airline or hotel costs. So some might find it convenient to use it for that purpose. On the other hand, if not used responsibly, for example, using it for gambling or racking up large balances at the end of the month and not paying it will have a negative impact on your finances short and long term.
Here are some tips that might be helpful. Number 1. Make the minimum payments on time. Number 2. Make additional payments if possible to the minimum amount. For example, if you have extra money in your checking account, go ahead and pay off a portion of the balance. Remember the high interest rate being charged, which in most instances is over 20%. Number 3. Do not carry a balance greater than 30% of your credit limit month over month. This will negatively impact your credit score. If you follow these simple rules, your credit score will improve over time and it in the end will allow you to reach your financial goals.
Feel free to leave your questions in the comment sections below. We are here to help and answer any inquiries you may have. Please watch part 2 of the loan series, which explains loan amortization in detail, how it works, deferment, and the do's and don'ts during the loan life. And please don't forget to follow us on YouTube, Facebook, Twitter, Instagram, and TikTok.